Timbol. My platform is to share instructional tips, inspiration, and strategies. Welcome for another round of Power Up Your Instruction. For those who are new in this channel, please hit subscribe. Please subscribe for the latest instructional tips and inspirational journey of a global teacher, and thank you. In this webinar session entitled ABC of Investing, our speaker will guide us with helpful insights on how to manage our finances and start investing wisely. Our guest speaker is a lawyer CPA, author of the book ABCs of Investing for Generation XYZ, published by Eagle Eye Charities. Carol works as a family wealth advisor holding securities licenses Series 7, 56, 6, and 61. She also writes for Inquirer.net and sits on the board of governors of New York Press Club. Carol is also an oil painter, founder of EagleCharities.org online gallery, featured artist of Makati City 2004 with solo and benefit shows at the Philippine Center, New York City, Museo ng Makati, Glorieta Center, and Mega Mall ART Center, Philippines. Our guest speaker is Carol Tanjutko, and let us start our webinar session with her now.
Hello everyone, I'm Carol Tanjutko. Thank you for joining me in the first of the series, ABC of Investing. This is based on my book, ABCs of Investing for Gen XYZ. First off, I gotta remind you that this is purely for free educational outreach, and this is not to be concluded as a professional advice, not a financial advice, tax, or legal advice. For that purpose, please refer to your professional advisors. Thank you. All right, let's get started. One of the first things I ask my clients in the past 10 years that I've been in this business is, how do you feel about the market? Volatility is a big issue. Every single day when you hear from the news, the radio, people are talking about it. The market is up and then suddenly the market is down. Well, exactly how does that make you feel like? And then do you look at your 401k, at your investments? Now, timeline is one of the issues that I would like to talk to you about. So as we move forward, I will talk to you about the basic principles to keep in mind. And also, I'd like to give you some pointers on how to avoid mistakes. So let's keep going. First, let me give you some basic Wall Street lingo. Bears versus bulls, exactly what does that mean? You hear it a lot. Bearish or are you bullish? All right, a bear, think about a bear, for example. How does a bear strike? The paws are going down, right? That means the stock market is going down. And a bull with the horns, it's going up, which means the stock market is going up. So that's a pretty simple analogy, but you will hear it all the time. Now, let's talk about the basic stocks and bonds. What are the rates and what are stocks or what are bonds? Stocks basically is an ownership. It represents an ownership in a company. If the company profits, then your money makes some profit. If the company loses, it's possible that you could lose all or some of your investment. Bonds, on the other hand, it's like a credit instrument. It's an IOU. So this time the company is borrowing money from you. Now it could be a private corporation or it could be a government. What are the other risks involved? Well, in case the company loses everything, if you have stocks, then you may be the last to recover your money. It depends on what kind of stocks, because there are several kinds of stocks, but definitely between the creditor and the owners are the last to recover. Bonds, for example, these are credit instruments, like I mentioned, and if the company who owe the money from you, then you have a right of recovery first, a priority over the owners. Of course, the government gets their taxes first, but then you as a creditor gets a good priority. So basically, it's either you invest as an owner or you invest as a creditor. When we talk of stocks too, you heard about the S&P 500. Let me just take a little. Okay, you heard about S&P 500. These are the 500 largest corporations in the United States. And these are your familiar names like Apple, IBM, Alphabet, Google, and then the big financial institutions, Citi, and then you have some biotech there like Pfizer. In this industry, we have what you call the rule of 72. Now, when you invest your money, what is your objective? You want to make money, right? And probably at the back of your mind, your question is, how long does it take you to double your money? In what we call the rule of 72, take a look at these hypothetical returns from 2% all the way up to 12%, just as an example. If you talk about the last 10 years of the bull market after the recession of 2008, so I'm talking about more in 2010 upwards, up to 2000, up to 2020, as a matter of fact. The average return is approximately 12%. Of course, there were down years, there's 1 or 2 years that's below, but the average is 12%. If you do get that average, that means it takes you only 6 years to double your money. So you put 100,000 6 years ago, it would have been how much? 200,000 under the rule of 72. However, if you're making on the average 8%, which is the normal return of a stock in the S&P 500, then in 9 years, you would have doubled your money. And that's not so bad. What about bonds? If you have corporate bonds, for instance, this is the higher yielding bonds that's paid to you by private companies, let's say paying 4%, then that means in 18 years, you would have doubled your money. It's a little bit longer time, right? What if you own government bonds? Now it's going to take you a lot longer. In the past years, the government bond made an average of 2% return, which means it takes you about 36 years to double your money. Well, we all know that with the bear market right now, the bonds, they return about 1%. And so at 1%, how long will it take you to double your money? 72 years, that's right. With that in mind, let's have a real expectation. I would like to talk to you about avoiding mistakes. Mistakes is not entirely avoidable, but there are things that you need to know to minimize. First of all is keeping your expectations realistic. Let's not dream of an overnight double your money kind of a deal or a promise 20% year after year after year. You know, as the saying goes, if it's too good to be true, it's probably not true. So make sure when you're dealing with people, you have the ability to check who's the broker. There's a broker's check at finra.org. That's why I always tell my clients it's good to have your investments at home in the United States because we have a way of verifying who are the brokers and who are the dealers and what are their records, if any. All right, let's talk about the common stocks again in the S&P 500, the 500 largest corporation in America. The past 25 years made about 9%, or it could be sometimes 8%. The past 5 years, though, might show a little bit higher, like 14%, but don't always count on that. Let's be realistic. If you're in here for the long haul, then don't think about the 5 years. Corporate bonds, I would say 6%. This is actually based on some studies. The past 5 years, 3.85%, which is very realistic for the last 5 years. Now, the government bonds, on the other hand, can be as low as 1.22%, especially in the last 5 years. But if you think about the last 25 years, the government bonds is doing spectacular. So here you can see it was 5%. Should you expect that? Well, like I said, let's keep it realistic. And this time, probably not. Let's look more on the 1 to 2%. Another strategy that I remind my clients is diversification. You don't put all your eggs in one basket. Just because Apple is doing so well, you really don't want to put all your money in the Apple stocks. You can think of mutual funds. Now, in the next series, I will slice and dice the mutual funds, the ABCs of mutual funds. What are the things that you have to know in mutual funds? But for now, let's make it simple, stocks and bonds. Now, we have what you call an asset allocation. An asset allocation is like a basket of different types of stocks, bonds, and mutual funds. Now, take a look at the conservative allocation. It pays 40% in equity and 60% on the stocks, all right? If you want to go moderate, meaning you want to increase your stock holding, you can do 60% of stocks and 40% in the bonds. If you want to get a little higher growth, okay, then you can do a moderate growth, which is 80% of stocks and 20% of the bonds. And of course, the growth sector, that's 100% of stocks. Now, be prepared that the more stocks you have, the higher risk that you're holding in your assets. The other thing that I remind everyone is when you invest in the financial market, invest for the long term. Think long term. Now, let me take you back in the time of the Great Depression. Take a look here. Let's roll back the time in 1929 when the Great Depression was just getting started. In the 1930, about 25% of the market went down. The following year, 1931, by the end of 1931, half of the value of the stock holdings went down. At this time, most of the people left the market. Now, that's another thing I'm going to speak to you about, to stay or not to stay. However, if you stayed at that time in 1930, to take a look, it went right back up. At this point, it's just negative 8% of the market cost or the market value. But in the following year, in 1933, this was the time that the Social Security law was born, and there's no regulation by the government. Stocks all the way up to 53%, 53.99 based on this chart. This is actual chart, by the way. Now, think about what happened in the last recession, or we might say the Great Recession. Now, what's the difference between the recession and the depression? Well, a recession, it lasts only about 18 months. The depression lasts about 36 months or 3 years, as it happened in this from 1929 to 1932. The latest experience we had with the recession was in 2008 when the stocks went down to about 40%. So if you recall back in the days when they say the 401k became a 201k because it's only half the value, a lot of people left the market at that point. But here's the problem. Those who left the market, they forget to go back to the market. So the following year, in 2009, by the end of 2009, the market went crawling back, and it made 26%. And it kept moving up 10 years later. I remember that in 2014, I have a fund that was making like 40% for just one fund. It was a spectacular bull market run for the next 10 years. However, if you left and you forgot to come back to the market, then you would still be at the losing streak. In other words, you keep the loss. The other point I want to tell you is avoid market timing. Market timing is you go in and then you go out, you stay out of the market for a year or a couple of years, maybe you're busy and you totally forget about it. Unless you know the funds and the market so well, market timing is a very dangerous game. Also, when you do the market timing for even for professionals, they don't really stay out of the market that long. And here's why. There's a penalty for missing the market. Here on the chart, you could see that if you invested 100% and never moved, you would have made about $20,000 just by not moving. But because you moved and you missed the best 10 days of the market, I'm just talking about 10 days, not being in the market. And then you came back to the market, listen, you made 10,000, but that's 10,000 less had you not moved at all. Now, if you miss the best 20 days, your earnings would be approximately 6,500, and this is based on real study. You miss the best 30 days, well, your earnings is down to 4,000. Is that fine? Well, you still made money because you went back to the market. So one of the things that I would like to ask my clients at this point is, how do you feel about the market? Are you okay with the up and down? Meaning you can lose, but you can also gain. So are you okay with riding the roller coaster? Another strategy to minimize the volatility, we call it the dollar cost averaging. In the dollar cost averaging, when you're moving, for example, you just retired and you're moving to an IRA, the first thing that I would recommend to my clients is to put the money in a dollar cost averaging account. What the DCA is doing is, for example, 100,000, you put it in a DCA account, it earns like a fixed interest of about 4% to 6% per year. So that's an added approximately 2% to your portfolio. Now, when you put in a DCA account, what happens is every month, 1/6 of that 100,000 will be invested in the market. So you see, you're not outright purchasing stocks at that particular point in time. It's spread out over 6 months. So the DCA 6 months means that we give you 6 months in order to invest your money. And at that point, the pricing of the assets that we get for you will be varying. So take a look at the study that we did here. There's time that you can get it a higher mark, let's say at $17 a share, then probably the following month we're getting it 15, the following month we're getting it 16. So they're all different pricing. Now what we learned is when we apply the DCA, we get the best pricing possible on the average 14, which is the best, as opposed to buying all the holdings at, let's say, 17. So with the DCA also, you avoid the sudden dip in the market. If, for example, you roll over a retirement account to an IRA and suddenly the stock went down, then you're down because you invested it one shot at that point in time. But if it's sitting in a DCA account, earning some fixed interest, then you kind of avoid that downtime, and hopefully in the next 2, 3, 4, 5 months, it's altogether different. Now, let me bring you to some basic principles in investing. When I speak to people about investing, there are four important elements that I would like to find out. And one of them is time horizon. How much time do you have before you will start spending the money invested? So time horizon is basically expressed in number of years when you will need the money. For example, you're thinking of putting away money for college of your children, but how old are the children? Are they newborn? Are we talking about 15 years? Or are they now in high school? So are we talking about 4 or 5 years? Because it matters to an advisor on what vehicle are we going to recommend to you. Now, when you have the time in your favor, let's say 15 years, well, yes, you can go a little bit aggressive. Now, that is a topic for the next series, series 2. The other question I'll have for you is your liquidity. How much cash do you have just in case there is an emergency in the family? So at this point, I'd like to know your cash in bank, CDs, or even your money market account. Or yeah, the money that you have probably under the mattress. That too is part of liquidity. And then I try to learn a little bit more about you, your spending habits, your budget. All these are important in trying to determine what kind of investment you should get into, and also your risk tolerance. The risk tolerance is really measured by your emotional reaction to the market condition, your reaction to the news, what you heard on CNBC this morning. It's the fluctuation of the prices. Are these affecting you? Then it's also a personal belief. Well, what do you think? Where is this market going? It is very important to know whether a person feels positively or negatively about a situation. One of the questions that we ask when we're trying to determine suitability is, how do you feel if your money will lose 10% of the value today? How do you feel? Are you going to get out of the market or are you going to stay? How do you feel if you're going to lose 10%, but you can possibly make twice as much in the next month? Are you going to stay? Now, remember, there's no guarantee to any of this. This is the financial market. As we always say, you may be looking at the past historical value, but there's no guarantee to the future. And finally, we want to talk about your experience. Now, let's talk about our personalities, our belief, our attitude to things, persons, places, what we hear in the news, what we see, and most especially, what we experience in the family. These are based on the preconceived notion. What did we hear from our parents? Remember the recession in 2008? What were your parents saying about their 401k that turned into 201? So just remember those times that your parents were so worried about their future, about retiring, that probably they will never ever be able to retire, or they may have to work at McDonald's after retirement. These are all very real concerns. And your decision today will also be based on what you experienced in the past, because this is part of the character that you acquired, the personality. Investing for the first time is learned from our job also. So remember, the first time you work and you have what you call the 401k. This is a section in the IRS 401, section 401k in the IRS that allows you to take a deduction from your taxable income. So the maximum change every year Let's say the maximum for this year is 22,500. And if you put away 22,500 at the end of 1 year and you're making, let's say, $80,000, that's a big adjustment to your gross income. So from 80, you minus the 22, and you minus again your personal exemptions, which is higher for this tax year, then your taxable income really goes really low. So it is highly recommended to everyone, even to you, young people of the next generation, Gen X, Y, and Z. Set aside about 15% of what you earn today. That means a little saving on that macchiato, a little saving on the eating out. But at the end of 1 year, you will be very pleased to know that you set aside $15,000, or even better if you set aside $22,000. It is really going to accumulate. In only 5 years, think about it, you're going to have 100,000. And for all you new generation X, Y, and Z, maybe retirement is not an issue to you. However, you just wanted to gig or things that, you have no boss, you are your own boss. Well, think about it. Put away that money. And in the next 10, 20 years, you're retired. You're ready to do whatever it is that pleasures you, art, film, name it. Now, a quick one thing here is the after-tax Roth that you see on the screen. There's also an after-tax Roth 401k. So if the tax deduction is not an issue for you, I would take, especially for you young people, I'll take the Roth 401k and pay the tax today and not ever have to pay the tax tomorrow. Because remember, if time is on your side, then take the advantage of not having to pay taxes. Double your money. Rule of 72, remember? Double your money in 9 years if you're making an 8% return. And then keep your money. You made 200,000, now it becomes 200,000. That's pretty good start up. All right. For now, I would like to remind everyone to take a free download of my book, ABCs of Investing for Gen XYZ. It's available at Amazon and it's absolutely free. I donated the contents of this book for the nonprofit Eagle Eye Charities that work with the sole goal of sending you free educational materials. I'm a member of the New York State Society of CPAs, and every year we get invited to a financial planning day right here in New York City. And this is one of the things that I do. But right now, whether you're in New York or outside of New York, I would like you to take advantage of this free learning course. Today is September 10th, which is the kickoff of this series. This is going out for free September 10 and 11. So go to this Amazon link right here, or just Google ABCs of Investing for Gen XYZ. Put it in the search bar of Amazon.com and please download your free copy. Until the next series, in series 2, I will take you to a deeper dive of investing. So for now, until the next series, ABCs of Investing, thank you so much for joining me, and I look forward to sharing with you more as we take into a deep dive of the investing world. Once again, I'm Carol Tanhutko.